the show, we have Darren Mitchell with Control and Compound. I got to hear him speak a couple months ago at a real estate conference. One of my favorite presenters there. I thought you did a great job of not just trying to sell your product, but actually it was mostly advice. It was talking to people about, wealth destroyers, different angles, like different things they can do to invest. So I really wanted to have you on. I think it's a great message. If you, just for people who don't, who haven't checked out the podcast or any of your books, could you give a brief description of kind of what you do at Control and Compound?
Sure. Thanks for that. Yeah, and actually, what we call ourselves is financial educators, right? Like, we at the end of the day, we sell life insurance. We use a specific type of life insurance, cash value life insurance. Infinite banking concept is a term a lot of people are familiar with. We use it for Canadians coast to coast. We work in every province. Business owners, real estate investors are probably 90 or 95% of our market. We think it's the best. The concept is the best fit for them. But basically, we're looking to say we think the greatest investment you can ever make is when you invest in yourself, invest in a business you own, or invest in real estate. Those are the three ways that people have made money through the last, well, since eternity in this world. You invest in yourself, you invest in business, you invest in real estate. So that's where we think you should invest. We think the best place to save your money is this cash value life insurance. And it's not like your parents' life insurance. This is a pure focus on how do we drive up the cash value to leverage that cash value to then go do real estate, go invest in your business, or go invest in yourself. So we can actually multiply money like a bank. And really that's, when you come to Control and Compound, the first session we meet with is nothing purely but an education session where we give you a complimentary session saying, let's educate the crap out of you. At the end of that session, you decide if you want to continue learning more through us or thank us for our time. But we're just financial educators. But at the end of the day, the life insurance product is the product that we will help you implement ourselves.
Yeah, I think that's great. I think financial education is so lacking, and I find it crazy because I tell a lot of people about infinite banking just to look into it, whether they want to do it or not. And most people have never heard of it. And myself included, the first time I got presented with life insurance, it's like you have one option that's maybe $50 a month, and then there's one that's whatever, 5,000 or whatever, 500. And I'm like, well, that seems like a scam. I'm going to go with the cheap one. But when you really dig into it a little more, I think you can definitely see the benefit to the whole life policy.
Yeah, I mean, your money has to reside somewhere, and we consider it a savings vehicle, and we consider it your own bank. So we think you should be your own banker instead of giving the bank all that power, because the number one thing that I've learned when I've studied the wealthy is they will not give up control of money. Right. So our business is called Control and Compound, and those three words aren't accidental. We believe those are the three most important words in the English language with respect to money. Control is I want to be ready for opportunities when they come my way, and I want to be ready for financial emergencies when they come your way. And stands for an and asset. My money's in the policy. I leave it in the policy. I leverage the insurance company's money, so I have the cash value growing uninterrupted and my real estate. And then the compounding, uninterrupted compounding, and those are the avoiding those wealth destroyers. But for me, I used to get excited about the compound, and it's still amazing. But the control, because when you have access to money, opportunity will find you. And the idea that we would say to a 20, 30-year-old real estate investor or entrepreneur, well, what I think you should do with your money is you should give up control of it completely, put it in a nice balanced mutual fund with the bank, in an RRSP, and leave it there for the next 41 years in the bank's control. And then when you turn 71, turn it into a RIF, cross your fingers, and hopefully the monthly income you get from that they'll drip back to you for the next 20 years while they control your money is enough to get by. Like, that's just crazy to me. If you want to be a T4 employee, work at the government, put an extra $100 in your RRSP, have at her. You're not a good fit for what we do. We deal with people that want to take advantage of opportunities, want to deal with emergencies. And to do that, we believe you need to be in control. And we think cash value life insurance is the best position to give you that control as well as the tax-free growth. And there is this little thing called death benefit that people sometimes think is an afterthought. But as you get older, there's only two guarantees in life, and one of them is taxes, and the other one's going to pay out a big tax-free lump sum when you die.
Yeah, I think you touched on it there, but it's always amazed me how people, you don't trust the government for anything. Any program they have is so inefficient, right? But then 100% of their retirement plan is in RSP or something that the government is their partner in, and it's just mind blowing to me. You don't have any control, exactly like you said, of the money. You can't take it out when you want without huge penalty.
Well, picture Shane, if someone came into your office tomorrow and I came in, or say I came into your office and I said, Shane, hey, I think you and I should go into business together. Why don't you put up all the money? You take all the risk, you pay all the fees, you'll have no control. And I'll let you know in about 40 years how much of the business is yours and how much of it is mine. And by the way, I spend like a drunken sailor. So I'm probably going to need a lot of that money down the road. I mean, people would like, you're crazy. Well, I'm like, well, that's exactly what an RSP is, right? So you give up, you pay all the money, give up control, pay all the fees, take all the risk, and then the government lets you know in 40 years how much they're going to take via tax with current tax or the tax rate at the time versus now. When Trudeau increased the top tax bracket by 4%, all that was him saying, I want an extra 4% of this business we have together. So, when you take that money out of your RSP, you're going to pay an extra 4%. And when we tell people, do you know what happens with RSPs when the second spouse dies? They're like dumbfounded. Well, what do you mean? It goes to my kids. I'm like, yeah, well, depends on what province, but 45 to 50 cents goes to your kids and the rest goes to the government. So that's what happens with an RSP. So if you're in the real estate business and you want to hang on to those properties and you think RSPs are going to help your kids pay that tax or final tax bill or be able to keep the properties going, you're going to have to deduct half at death front just to pay
Yeah,
taxes.
definitely. So, can you give kind of just like so people can understand what this whole life is, right? Like how you can front load the policy, or like, 'cause I don't think most people, I would say very few people actually understand what it even is and how it works and why it is tax efficient.
Yeah, so let's talk about it like again from a savings program kind of thing. So a typical policy, someone might come in and say, "Great, uh, um, um, I'm no longer doing RSPs. I'm a little concerned about putting my money in the stock market because when the opportunities come along, usually that's when the stock market and real estate market crash. So I want to save some money, and it could be $1,000 a month, or it could be 30, 50 grand a year. Doesn't really matter. People I always say to people, they go, how much do I have to put in? And I'm like, well, how big of an opportunity do you want to take advantage of? Right. So I put in multiple six figures a year because I want to take advantage of big opportunities. So you put money in this cash value. Let's say it's 20 grand a year. You put 20 grand a year in for, 10 years, 20 years, some period of time. Some of them we can do where, you can put in maybe 2 years premium up front to kind of jumpstart it, or maybe put a lump sum in and then a smaller amount after that. But some variation of that where you're going to put money into this insurance policy. It's going to grow tax free. The loans you get on that will be tax free, and the death benefit will be tax free. So let's say you put 20 grand a year in, and then in 5, 6 years down the road, or 2 years down the road, let's use 5 or 6, you go, great, I want to do a private lending deal, and I can loan 100 grand out at 15%. And I'm going to go, okay, great. So they're going to go, okay, cash out that policy and give me my 100 grand so I can go do the policy. And I'm like, well, you're thinking like an OR asset, because every asset we have is an OR asset. Do I put money in a real estate, or do I put it into my coach, or do I put it in my business, or do I put it into whatever, RSPs? Well, this cash value life insurance is an and asset. Because if I have, say, $110,000 of cash value in my policy, or 115,000 in my policy, the insurance company guarantees that you can leverage 90% of that, no questions asked. They don't ask what your financials are. They don't ask what the investment is. You're not required to make an interest payment. They will charge you interest, and we encourage you to pay it back if you're not going to pay it back in a year. But to walk you through that example, instead of loaning my money out at 15%, I put it in the insurance policy first. I borrowed from the insurance policy. This was a couple of years ago when the rates were down a little, and the interest rate on that was 5%. And then I invested it in the private lend, and I got 15%. Okay. However, I also got about between 5.5%, 6% growth inside the policy for the entire amount. So in my example, the full $115,000 in the cash value was continuing to grow at that 5 or 6%, and I was making money at the 15%. And then that loan, the interest I paid on the loan, The fallacy is you pay interest to borrow your own money. Well, no, if I was borrowing my own money, I wouldn't still have 115 in my policy. I'd only have 15. I didn't touch my money. My money stayed in the policy, but the insurance company gave me their money just with my cash value as collateral. And the reason they'll go to 90%, because as much as I like real estate, this is safer than real estate because it's guaranteed not to go down. It's guaranteed to go up every year. This is the cash value, guaranteed to go up. And we've got a 150-year track record of paying a dividend each and every year. So that's why they're happy to loan you money, because they know that's going up in value. They know it can't drop. And if worst case scenario, you die, oh yeah, there's this big tax-free death benefit that gets paid out that they can get their $100,000 back. So that's key. And I think, like, to stick on the real estate investors, I bought a fourplex. For the down payment, I borrowed from my cash value, right? I was brainwashing my kids at the time, and I said, uh, great opportunity, great cash flow. Can I get from my RSPs? No, Dad, that money's in jail. I was like, all right, they're listening. Couldn't get it from their education fund. But I called the insurance company up and said, hey, give me 80 grand. They said, sure. They didn't ask me what I was using it for, when I was paying it back, any questions. They just said, sure. Went to the bank and I said, hey, I need a mortgage for this fourplex. First question they asked, where'd the down payment come from? I said, I borrowed against my cash value. They said, cool. We don't consider that a loan. So I was able to do that, cash flow it, eventually pay off that policy loan on a refinance. And we call those and opportunities. My money was still in the policy. It grew exactly the same whether I'd taken a loan or not. And it was be able to take advantage of the real estate. And then, I've done some multifamily the same way. Happy to talk about how I use it for multifamily as well.
If you put the money in from a business, does the loan have to come out from the same business, or is there any way to do it so it comes out personal?
Yeah. So there's great question. So we do a lot of policies corporately. And the reason why we call them 88-cent dollars, depending what province, maybe 90-cent dollars where you live, but most provinces, your small business tax on the first $500,000 of income is going to be around 12%. So you get two options. You earn $1 in your company. You can say as an entrepreneur, I'll take that as a salary or bonus, and I'll be left with roughly 50 cents. So I have 50-cent dollars, or I can leave it in my corporation and have 88 cents. And people say, cool, let's invest 88 cents instead of 50. It's like 76% return already. But what they don't look is, what else extra levels of taxation have you introduced? You're going to pay tax on the growth. You're going to pay tax when you get that money out of the corp. You're going to pay tax when you die. You're going to pay tax if you exceed $50,000 of passive income. And you're now going to pay 67% inclusion on your capital gains from $1. So that's 5 levels of taxation when you invest inside a corporation that we can eliminate by putting this tax-free life insurance vehicle inside of this. So when you go to get the loan, there's 2 types of loan that you can get. The easy one is the policy loan, super easy. Literally call up the insurance company, say, hey, I need up to 90% of my cash value, whatever it is. That loan's always going to go back to the policy holder. So in a corporation, for instance, I own them in my holding company. Okay, my corporate owned policies, my personal I own personally. So my holding company, that's where I buy my real estate. So if I need 100 grand for a real estate deal, I call the insurance company up and say, hey, give me 100 grand of your money. I grow it in there. But once you get to a point where you've got significant cash value in there, like a couple 100,000, you can have 2 options. You can get a corporate loan, or you can get a personal loan on that corporate policy. So sometimes it makes sense in the mid years to take that personal loan, depends upon the circumstances or where you're buying that asset. But where we really see the personal loans are in retirement. So we talk to a 40-year-old and we say, listen, we'll put this with your cheap corporate dollars in your holding company or your operating company, whatever you decide. We'll do a bunch of deals in there. We'll borrow it to put back in the business. We'll borrow it to do real estate. But when you're 60 or 70 years old and you're doing something else, not full time maybe, but I don't think anyone should ever retire, just do different things. Now you're 60 or 70 and you go, well, this was cool. Well, then you can actually get a personal loan on that corporate policy that's completely tax free. So if you get $1 million of cash value, you could say, well, great, why don't I take an $80,000, $100,000 a year, tax-free income, a loan against an asset, and then you die, and then that loan is say 1,200,000. Well, your cash value of 1,000,000 probably grew to $2 million while you were retired because that was continuing to grow and you're on the sexy part of the compound curve. And then that little thing you didn't care about before, the death benefit, well, that's probably grown to 3 million. So now you die, $3 million gets paid to the corp, flows out tax free to your family. 1.2 million in my example goes to pay off the loan. Your family has 1.8 million. So we're now again, there's like some a lot of details you need to go through. I'm making it sound super easy. It's we do it every single day. It's super easy for us, but there's a lot of things you got to do right to make that happen. But we do it every single day, and it is one of the last bastions that business owners have to really grow their wealth, not subject to tax, and live a tax free retirement. My goal for my kids would be a zero tax environment when they retire. TFSAs, real estate, and cash value life insurance.
Yeah. Is there an age where it doesn't make sense to do the pot? Like if you're 60, like is the premium part of it going to be too much that it doesn't make sense?
Yeah, depending upon what you're going to accomplish. Typically, most people are under 60. If they're married, we can usually get up to 65 if the two of them are still in relatively good health, or if they're going to work another 7-8 years, because most of these policies need to be funded for a while. But the misconception about age is we get it all the time. I was in the office this morning for a meeting, and it was a 50-year-old, and sure enough, they said, "Oh, I wish we were 25 when we did this. Oh, we get a 25-year-old kid. Should we put it on our 25-year-old kid instead of us?" And again, intuitively, that kind of makes sense, right? Insurance on a 25-year-old is going to be way cheaper than insurance on a 50-year-old. But that's for traditional life insurance. That's if you're buying $1 million of death benefit. Absolutely. 50-year-old is going to be way more money. But if you look at it, say a $20,000 a year deposit on a 50-year-old and a 25-year-old, the cash value after 10 years would be almost identical for a 50-year-old and a 25-year-old. Now, most of the money is going to go to the cash value, and that's going to be about the same amount of money in both cases going towards cash value. A little bit of the premium is going to go towards death benefit. And all it is the same numbers of dollars would go towards death benefit for the 50-year-old or the 25-year-old, but the 25-year-old might come out with a $600,000 starting death benefit, and the 50-year-old might come out with a $200,000 starting death benefit, but the cash value is going to be the same. So really, we do a lot of policies for people in their 50s where they think they're too old, but that's the exact opposite, because the bulk of the money is really going towards this cash, which isn't age sensitive. It totally makes sense up to that 60, 65. We can start a policy as early as 14 days and go up to age 85. You get up in your late 60s and 70s. This can work great for death benefit, but to build cash, we're up against a wall. We don't have a lot of time to
Yeah.
build that.
So
Yeah,
one thing I
exactly.
wanted to touch on for sure, because I think you do a good job of kind of explaining the wealth destroyers to people, because I don't think most people just don't understand it, like volatility or how much is really getting paid in taxes. Like you touched on RSPs, they're looking at what they have in there. They're not looking at that's at least 50% of that is going to taxes when you take it out, right? So
Yeah.
could you touch on kind of your three wealth destroyers?
Sure. So we have four wealth destroyers. Actually, we talk about talked about three at the conference, but you think of the compound interest curve, right? That's your hockey stick from exponential growth curve in high school math. Well, that's when I studied the wealthy, and again, I spent a lot of time traveling around North America after 2008 when the stock market crashed, and I was like, never again will I be in this situation for my money or my clients' money. And when I studied the wealthy, they're all about compound interest, but the word people miss is uninterrupted compound interest. So to compound and then go back to zero and compound and go back to zero doesn't get you ahead. The whole idea is, how do I stay on that compound interest curve? And we believe there's four things that knock you off that compound interest curve. And number one in Canada, no surprise, is tax. Again, you grow at 10% a year and you pay 50% tax, your growth rate is exponentially different than if you don't pay tax. I use that example at the conference, $7,000 in 100 years at 10% grows to 100 million. If you pay 50% tax just on the growth, it'll grow to just under a million. So $99 million of it. So the wealthy look at, how do I grow it tax free? And the cash value grows tax free. The loans are tax free. The death benefit's tax free. That's number one, taxes. The second one is fees. So again, every mutual fund in Canada has these hidden fees behind the scenes. The average is still around 2.2%. Now you can get lower fees on that. But the product we use, there's only a couple different insurance companies that offer the one that we use. Their fees are down to 10, 12 basis points, so like 0.12, 0.13 versus 2.2. So that's almost like that's a 2%. The difference of 2.2 or 0.2, like it's a huge difference. So you look at what those fees erode your wealth over time, and those numbers are mind-boggling. So that's taxes, that's fees. The next one is spending, right? And a typical spending one, real estate would be a great example. You're saving money someplace, you're saving. All of a sudden, you got $100,000 saved up, and you have a great opportunity to put a basement apartment in one of your units. The town you're in, great, says you can do that now. Okay, great. What do? Well, they typically cash out that $100,000 investment. But if you think of the compound interest curve, you got 5 or 6 years of compound growth, and then you went right down to zero again, and you restart the compounding. So our strategy is, once you get on that compound interest curve, never get off it. Literally till the day you die, don't get off it. So if you need to access money, instead of using your own money, we're going to say, leave your money in the policy, let it continue to compound tax free, and we'll leverage those loans that don't affect your compound interest curve, because the loans are the insurance company giving you them money. So taxes, fees, spending, and then volatility is the other big one, right? Again, most opportunities, the biggest opportunities come along when things are down. So in 2008, when the stock market crashed and real estate market crashed, people couldn't access money because, and even if they could, it wouldn't have probably made sense. If you sell an investment when it's down 40%, you'll never recover. So our idea is to avoid that volatility. This cash value life insurance is guaranteed to go up, cannot go down, and has a 150-year track record of paying a dividend each and every year. So there's almost no volatility at all in cash value life insurance. So we've eliminated those 4 wealth destroyers. You could throw a fifth in there, which is inflation, and our growth is going to keep more than pace with inflation long term. So we've eliminated those wealth destroyers. Compound interest is no good if it's being interrupted by one of those wealth destroyers.
Well, I noticed you skipped right over spending there, and I was going to maybe have some tips for my wife, to listen to here, but um, no, that's good. I think that's important. And I know it's totally different products, but I like real estate for a lot of the same things. You can defer a lot of the taxes
Yeah.
out. You don't have the volatility, as long as you're not buying and selling, it doesn't affect you near the same, and you can kind of protect some of that stuff. So,
But even in real estate, so I did this with typically it's a stock market we look at, but I had a client a number of years ago, not that many years ago, when Alberta wasn't doing well in the valuations. Calgary was dropping, Calgary was coming down, and these people were retiring, and they're like, "Holy crap, we've got to sell these buildings because we want to again sleep indoors and eat. We got to sell these buildings when they're down. Like, wow, this is gonna hurt." And I was like, well, wait a minute. Remember when we talked about this cash value life insurance policy you started years ago? Why don't we give that real estate a couple years to come back, and we could sell at the high? So, I think they were spending about 100 grand or 120 grand a year. They figured they needed to live off after taxes. So we just went to the insurance company and said, hey, can we have 10 grand a month for the next 2 years or whatever it was, borrow against the cash value? And then their properties spiked, and it was literally perfect timing, right? They were at the bottom retiring, and they were going to have to sell at a loss. And one spouse had a health issue, so they really wanted to stop working. So they were able to literally, boom, access the cash value. 2 years later, their properties values were up 35-40%, and then they sold their buildings. So it bought them that time to protect them from some volatility in the real estate I'm a huge believer in real estate investing. Now I'm into multifamily. I love multifamily, especially as a passive investor where I don't have to do
Yeah.
anything.
So if someone is, listening and they're really excited about doing it and then using that money to invest in real estate, how many is it, like a couple year process though, where you're kind of front loading that policy for a few years before you can actually take it out, or what does that look like?
Yeah, so there's four companies we deal with. Three of them allow you to take the money out in the first year, like literally the first month. One of them restricts it for a 12-month period. But I always caution people, and again, I told that couple I met with today, I'm like, this might not be the right time for you because what you got to remember, a cash value life insurance is going to grow like the value of a building where you do a renovation. So what I mean by that is, if I buy a property today and I put a few $100,000 in on a renovation, I am going to be underwater the first couple of years. I am going to be losing money in those first couple of years, but long term, I'm going to be wealthy. And cash value life insurance works exactly the same like that. If you threw in $50,000 year one, you're going to have access to less than $50,000 year one. Year two, you're gonna grow by almost as much as you put in. By year three, now you're by what you put in, you're gonna increase at least that much. And then long term, great, you're gonna grow at that 5 or 6% tax free. So it's a long term strategy. Typically, it's not a. So I tell real estate investors, if you're comfortable that you're the money you're going to put in here, if you could access 70 or 80% of that in the first year or two, that you're comfortable with that, then great. Now's the time to do it. But if you need every single penny you have to your name in the next 12 months, don't do the cash value life insurance today, because you can take a premium holiday, but you really can't do that until you've paid 2 years of deposit. So that could be in 12 months, you make your second deposit. Then you could take 2, 3, 4, 5 years off of paying. You have that flexibility, but you've got to get through those first 2 years to build yourself enough of a cushion where your cash value is at a point that it can sustain the insurance costs for a number of years. So that's the only thing I caution people is you're not going to have the same level of access or the same amount of money that can be accessed in the first
Yeah.
year or two. But it's like 70, 80%. It's not like zero.
And then how, like on most of these plans, maybe it's just totally different on everyone, but is the idea that after maybe year 5 or year 7, your premium is covered by, like, that you're not actually putting the premium in? When is that time usually?
Yeah, typically that's usually around 6, 7, 8 years where you could stop paying. The policy would work fine, continue to grow. But the re- the reality is, we get a lot of times it's people like 50 years old saying, "Okay, let's. I just want to pay this for 10 years. I'm going to retire at 60, and I'm gonna." And we're like, "Okay." I go, "But just humor me. Let's just put it in for 20 or 30 years that you're allowed to deposit. Humor me." And then sure enough, 10 years later, okay, maybe they're retiring, but it's like, well, do you have money coming in every year from someplace? Yeah. Does it need to reside someplace? Yeah. How's your cash value looking? It's never looked better. I'm through that first year or two hump. I put an extra 20 grand in this year. My policy is going to grow by 43. And I'm like, do you think you want to make a deposit in year 11? They're like, yeah. Because again, I make deposits all the time. And once you get through that first couple months or year, well, I kind of check the other month for 100 grand for one of my policies. Easiest check ever. Because if I need to make payroll in 3 months, great. I can just take a loan, take the insurance company's money, access the money easily, no tax, no implications, without affecting the growth of my policy, and make payroll. So knowing that you can access the money, because as a business owner, I used to either put money away in an RSP that would lock it away for like 50 years, or I'd be afraid to put money away because what if I need it for my business, or what if I need it for real estate? And now I find I'm saving a lot more because I'm putting the money away, knowing full well I'm going to be able to use this for a tax-free retirement. We didn't even really talk about retirement yet, but if I need money next month, next year, next quarter, 2 years, I know I have access to money, no questions asked. Doesn't show up on a credit report, those loans. They don't ask any financial questions. The only person that has to approve the loan is the person in the mirror. And the only time you'll ever get asked a question, now, normally people call into our office and we arrange everything. but it's literally when the first time I called the insurance company, they asked me two questions when I asked for money for a down payment. They said, Darren, do you want a check or do you want to deposit it in your bank account? That was it. They didn't ask me any additional information about what I needed it for, when I was paying it back, how I was paying it back, if I was paying it back. They just gave me their money using my cash value as collateral.
Yeah. Good. So the last thing I just wanted to touch on, because obviously we met, I seen you speak on a stage, and now we're doing a podcast and you're getting out to people. But how did you decide? Like, you don't see a ton of insurance people, having a personal brand or doing podcasts or books. Like, how did you decide to take that route to get out to people?
Yeah, so our kind of strategy the last, 5, 10 years really, but really the last 5 years was this is not a concept that you can say, hey, cool, I want to do this, sign me up. In fact, we get people calling all the time saying, oh, great, I want one of those. And we're like, no, like, unless you understand it, there's going to be problems down the road. There's so many benefits. I meet people all the time that think they have this and they don't. So, what we determined is the best way to serve our clients is to educate the crap out of them. So we started looking at, okay, if we can be in this field, the people that specialize in business owners and real estate investors across Canada, and we can do everything we can to educate them because, you know, I had a mentor tell me once people catch this, how it works, you can't uncatch it. Like once you see it, it's like, what do you mean I can multiply money? What do you mean my money can be in more than one place at a time? It can be in the policy and it can be in real estate and it can be providing me a death benefit and it's not affecting my growth, these loans. Like it's once you understand it. So what we decided to do is how can we best educate people? And the first thing was my book, Be the Bank, that is on Amazon. That was a huge success. And then Infinite Banking for Real Estate, a second book. And then we started a podcast. We got 150 episodes in there, Control and Compound. And from a branding perspective, that's been fantastic because we'll get people call up and go, "Hey, can I do a kids policy?" And our staff member will be like, "Yeah, let me send you a podcast that Darren and Christina did on a kids policy." So before we meet with someone, we've got a free webinars on our website they can watch. We've got books, we've got podcasts, we've got videos. We want them to take some initiative and do some education on their own. And then when they meet with us, we educate the crap out of them. So that's kind of how we started. Everything we do is education based. So whether it's the podcast, whether it's webinar, we've got all kinds of a couple exciting projects coming out in the fall. Everything is education based because if you learn this, there's no selling involved. Once people get to the end of the education process, those that get it typically are like, holy cow, I wish I'd started this years ago. Sign me up. And the last part is we really are huge on service in our industry, in the insurance business, and this resonate with a lot of listeners. You buy a policy and your advisor says, thank you very much. And then they're gone. And then you may see them again. You may, in 20 years, when your term renews, they might remember to call you if they're still in the business, but they're probably not. Uh, we meet with our clients on a regular basis because what we learn is if we continue to educate our clients and remind them the product they have, they just buy additional policies. And maybe they'll buy one on their kids the next year, one on their in their corporation or on their spouse. So we believe in education and service, and that's really how we're trying to build our company. Everything is around that.
And how did you, like, at the beginning when you just started? I'm sure it wasn't like you spent all this time writing a book, or you probably filmed the first 20 episodes and didn't get a lot of how
Yeah.
did you kind of do you track something, or did you just have in your head, look, we're doing this for 3 years and then we'll get a benefit? Or
Yeah, it doesn't matter how many times you hear it, whether it's social media, podcasts, it's consistent, do the work, consistent, do the work. It'll eventually it'll take. And you hear it a million times, but I got to tell you, you're 4 or 5 months in and you're going, what do you mean we had 300 views on our podcast or 300 down? Like, but really, it's true. It's good advice. If you put quality work out of there, we just basically, grew a little bit and then we just started growing exponentially because we, we put about 10 social media things out, Instagram, YouTube, TikTok, a little bit. Uh, Every week we're putting 10 pieces out. Every week, every month we're putting out 5 podcasts. We've got 2 books. We've got another book coming out in the fall. Like we've got another thing about helping kids in the fall. So everything we're doing is how do we be advocates for real estate investors and business owners across the country, and how do we educate them? But the social media and the podcast, it really was just like they told us, but you didn't want to believe them. Just keep at it, and eventually your numbers will grow exponentially, just like the compound curve. And that's what we found. Just be consistent
Very
about
good.
it.
Well, I'm always big on vision. What's for you? What's 10 years for Darren? What does that look like?
Well, I'm part of Strategic Coach 10X program, so we're looking to grow a lot. We've got staff now in Ontario, in the East Coast. We do a lot of work in Alberta and BC in particular. So eventually, we'd like physical offices out there, but we just want to grow and help as many people as we can. So we've got some cool initiatives we're launching in the fall that hopefully will help us accelerate that compound growth curve.
I like it. So people who want to get a hold of you, just control and compound anywhere, or what's the best way?
Yep. All our social medias are at Control and Compound. The podcast is Control and Compound, and our website is controlandcompound.com. From the website, you can watch those free webinars I talked about. You can access our podcast. There's links to buy the book. The books like my Be the Bank books, 99 cents for the Kindle version on Amazon, right? We're not looking to make a lot of money on this. We're looking to educate people. You can buy a paperback as well. But look for Be the Bank on Amazon's a good start, or check out the podcast or the website. Educate yourself. If it's something you're interested in, reach out. We've got contact information there. You can reach out for a complimentary education session.
Love it. Well, thanks a lot for coming on. I'm excited to see what the next couple years look like for you.
Cool. Thanks so much, Shane. Appreciate your time.